Okay, so the theme for this conference is investments on the move post-Cooper. And from AST's perspective, it's important to have a balanced debate around the Cooper Review final report. And to date, there's been a lot of commentary about MySuper, SuperStream, and the efficiency and governance of the system generally. However, there's really been little debate on investment fees. And this is surprising given that investment costs are the biggest single expense for any fund. Now, AST made a comprehensive submission to the Cooper Review, including on the question of investments and investment costs, and we recommended that a new investment fee structure be developed by the panel. We were therefore surprised when the final 500-odd page report was delivered to see that the report didn't really deal with the issue in any substantial way. It highlighted problems, but not solutions. One such problem the review did recognise was that of asset-based fees. It wasn't just the fact that they reward market growth without necessarily requiring more effort from fund managers. Cooper was also concerned that increased SG contributions would also increase fund manager fees. He noted that asset-based fees were in general taken for granted in our industry. And in a footnote to his final report, he remarked on an absence of submissions addressing the question of investment fee structures. His final report said the connection between the fees charged for managing a portfolio and the quantum of assets in that portfolio is taken for granted by many in the superannuation industry. The panel notes that the practice is broadly consistent with institutional investment practices, including pension funds around the globe. However, given increasing economies of scale and the consistent flow of SG contributions, attaching a fee to the level of assets alone seems suboptimal, as it is likely to lead to exponential growth in revenue for agents without a commensurate increase in underlying value to the members. Despite having that view, and despite being charged with the job of developing a fund management model, the review didn't actually produce a model or even come close. What the review did conclude is that trustees need to more rigorously assess the value of their actively managed investments. The review further recommended that performance fees in any MySuper option must meet the requirement of a performance fee standard, which is yet to be developed. And presumably now that the Gillard government has just been installed, that we will see MySuper be adopted and the performance fee standard also be adopted. Given this outcome or lack of outcomes, AST decided that it was going to take up the challenge to further the debate because we really felt that there was a hole left in the Cooper Review and that there was this area that was left untapped. Whilst the full research report covers a number of key issues, today we're just going to concentrate on the key 5 findings. Asset-based fees, do they serve the interest of trustees? Performance-based fees, do they work? Is there a fee structure that aligns trustee and fund manager interests? Will greater fee disclosure and consistency make a difference? And will fees decrease as a result? Early on in the research, it soon became clear that looking at investment fees also raised a large number of very interesting questions. And the key to a successful outcome for the research was maintaining a key focus on the question of investment fee structure. Questions about overall fee levels, net return to members, the value of active management are all critically important, but fundamental questions regarding the fee structures that best align the interest of trustees and fund managers have not received enough airtime. This research addresses these questions, but not at the expense of searching for the optimal fee structure. There are some people that say that net return to members is the critical question, and they're right. But that's not an excuse for ignoring fee structures and fee levels. Clearly, it is a better outcome to pay less for the same return and risk profile. It's also the case that fully disclosed and comparable fee information will lead to better informed trustees, higher levels of member understanding and better net return to member outcomes. So what we found, asset-based fees, do they serve the interest of trustees? Performance-based fees, do they work? Is there a fee structure that aligns trustees and fund manager interest? Will greater fee disclosure and consistency make a difference, and will fees decrease as a result? On the first one, the answer on asset-based fees, what we found, the answer to be was no. On performance-based fees, it's a maybe, and we'll talk about that some more. On is there a fee structure that can be aligned? Yes. Will greater disclosure and a fee disclosure and consistency make a difference? Yes. And will fees decrease as a result? Definitely. So on that note, I'm going to hand over to Bill, who's going to now take you through some of the detail of the research.
Thank you, Fiona, and good afternoon, everyone. Thank you for inviting us to address this imposing and erudite audience. I'm going to start with a quick warning. There's a concern that a focus on costs alone will lead to poorer outcomes for members, and we share that concern as well. However, there's value in examining fees, and I use the analogy of buying a car. Sure, we acknowledge that some cars go faster than others. We acknowledge that you need to pay more for a car that will go faster. But if you've decided you're going to buy a Ferrari, then you should have some idea of what to expect before you go into the showroom. Now, I'm going to divide this into four broad areas. The last one, fee disclosure, there's only 2 slides, so when I reach that, you'll know I'm on the home stretch. The quote from Nietzsche there is really referring to the fact this is a 50-page report that I'm trying to present in about 20 minutes, and so we're going to have to dive in fairly quickly and take pieces out of it and explain them in isolation and hopefully not leave myself in hot water. So starting off with asset-based fees. Sure, they're the established standard, and there are plenty of good reasons for that. Dividends, interest, capital gains, tax, everything is expressed in terms of assets. Underlying administration systems work with asset-based charges, and it's a much easier system to run. In fact, it's quite difficult to run with some other types of fee basis in typical unit pricing systems. Are there issues with them? I think the issues are fairly well known, and it's a matter of opinion as to how important or how significant those issues are. The major issue there is that the value of the assets is not always under the control of the manager. In fact, in the case of an index-based manager, it's dependent on how much money he's given to manage and what the cash flow is, and his job is to provide a service. We're going to provide a couple of examples to see what influence that might have. And if you're looking at index managers, you might argue there is a fixed cost structure, and so there should be some greater recognition of scale. First example, we're looking at a notional portfolio over a period of 10 years based on the growth in the Australian ASX All Ords Index. And we're treating it as though it's an index fund, so there's no question of whether the manager should be rewarded for active management. And the 2 sets of bars there, the taller ones, the lighter bars, are based on an asset-based fee of, I think, 20 basis points. We're looking at a portfolio starting off with 100 million and with a 10 million cash flow. Now, the dark blue, the lower set of bars, is effectively what would happen if, on the date when the mandate was given to the manager and the investor agreed on a fixed dollar fee subject to indexation annually at the AWATI index. And so there's quite a significant difference between those two. Now, just to show that we're not hammering fund managers unmercifully, here's what would happen over a shorter period of time, including the global financial crisis. And so the cash flow to the fund manager, sure, it escalates fairly rapidly, but it drops. It's not a good basis for running a fund management's business to have a cash flow that jumps around to that extent. Now, are there alternatives to asset-based fees? Well, there are some. One approach is a fixed dollar fee, which has been used on occasion, and we've just illustrated an example. Another approach might be to use an asset-based fee style, but don't base it on market value. So base it on the amount of the mandate and any net cash flow excluding investment income. And that will produce a similar sort of a stable fee basis to what you might get from a fixed dollar fee. In the full report, which I encourage you to download and read in great detail, there is an example of how that style of fee basis would work. There's also a possibility of not actually having a long-term fee basis, but because investment management contracts are renegotiated over periods of time, you could sit down with your manager and agree on what is a reasonable dollar fee basis for the next 3 years to cover their business needs and your requirements, and then review that again after 3 years based on the size of the funds under management and the outcomes during that period of time. Now, let's say that fixed dollar fees or alternatives to asset-based fees started to become popular. There are two potential commercial issues which could cause problems, particularly for smaller funds. And that is that if I was a fund manager, I probably would be looking at my projected cash flows and projected revenue I could earn from an asset-based fee, and I'd be looking for a higher initial dollar fee to compensate for that. And similarly, there is, to a certain extent, cross-subsidy between larger and smaller mandates. And so these two influences could result in higher fees under this type of basis. We'll come back to what could be done about this later. So we'll move now on to performance-based fees. And again, looking at the pros and cons, to me, the biggest argument in favour of a performance-based fee is that you pay for performance when it's there. So if the performance is there, there is the money to pay for the fee, and you can present that to members. And if there isn't any performance, then you're not paying more than the base fee. Also, potentially, performance fees compensate for or work against the desire to accumulate FUM as the only way of building fee revenue. And last but not least, in fact quite important, is that there is no choice in some asset classes. The Australian funds management or Australian superannuation industry does not have the clout to be able to influence, for example, in some global sectors, and particularly in some of the alternatives such as private equity. And trustees, by the results of the last few years, have indicated that there is value to be gained from investing in these types of assets, and that the performance fee, whatever the basis, is actually a necessary evil and makes it worthwhile still to invest in these assets. Now, taking the devil's advocate argument, a study that was presented in the Cooper Review and in one of the discussion papers, based on some research by Grant Thornton, suggested that based on a UK investigation, there is no indication that performance fees have a positive influence on performance. In other words, the argument that there is an incentive there for the manager to do better and work harder doesn't actually seem to have been brought out in practice. And there's also a concern that performance fees could lead to excessive risk-taking to try and improve performance and thereby gain a better fee. We'll see there are ways around that one. And Cooper also mentioned what he called the asymmetric effect, and we have a slide in a second just to explain what happens there. I think one of the major arguments against performance fees is that if you do manage to come up with a basis which works, which overcomes some of the weaknesses, it can be very complicated to work with. So I mentioned the problem of paying for volatility. This is very simple. There's a table here that shows a hypothetical case, year 1, 2, 3, where we've got a portfolio return, a benchmark and an excess return. And only in year 2 is the excess return positive, and under the notional performance fee basis we've got here, that would produce a performance fee in year 2. However, if you average the returns over the whole 3 years, there is no performance. And if you look at this type of basis applied on a yearly basis over a long period of time, effectively what can happen is the manager is being rewarded for the variation in the market. So as it's sometimes expressed, the investor is paying for beta. Is it possible to come up with a better performance fee basis? Is it possible to address some of these issues? There's nothing really new here, but we believe it is possible to do that. First of all, something perhaps that is slightly new is to use a risk-adjusted performance basis. And I'll give an example of how that could be done. If the base fee is not low enough, then you simply end up with a fee basis that pays more, and that has been one of the charges levelled against performance fees, that they just basically push fees up in general. And I've mentioned there the hurdle rate at least 50 basis points. One of the interesting things that came out of the research, and I'm sure most of you here will know this, is that a pure index manager in Australian equities can outperform the index by up to 50 basis points simply by managing tax and other simple things, so without being an active manager. So you'd expect an active manager to at least do that. And the longer measurement period, for example, measuring performance over 3 years rather than annually, can address the issue of paying for beta. And fee caps are common here as well. One of the things that we did, and it's in the report, is looked at some modelling of performance fees. I won't dwell on this slide except to explain that we used a series of 10 years of Intech returns for Australian equities to push through some sample performance fee basis to see what the outcome would be, and to test the influence of changing things like the averaging period, the fee cap and so on. You'll find in this presentation we're concentrating on Australian equities simply because of the limited time, and also because the principles are much more easily demonstrated here. The report has got information on other asset classes. To give an example of what comes out of the fee modelling, this simple bar chart here shows 4 different scenarios, 4 different types of fee bases. Along the bottom you can see the base case, which from memory was a 20% share of excess over the hurdle rate measured over 3 years, with a base fee of a fixed dollar around about 10 basis points. And so what happens if you change the parameters? Where the red bar intersects with the blue bar, that's the average fee paid over the period of time. And we've run this over effectively a period of about 300 years by using some notional figures. And so we're looking at the distribution of fees that come out, and the red bar shows the lowest fees through to the average, and the blue bar shows the average through to the largest fee that gets paid at any stage. For the technicians out there, the distribution is not a normal distribution. It can be quite different. So you can see that if you increase the share of profit, the average fee over a period of time goes up, not surprising. If you increase the cap, the average fee goes up not very much, because the extreme cases where the performance gets close to the cap are relatively infrequent. And if you take out the average, the average performance fee goes up a little bit, which illustrates the paying for beta point. I said I would mention the risk-adjusted returns. I'm an actuary, and it's very hard for us to do a presentation without at least putting one formula in here. I apologise to any actuaries or statisticians in the audience who can't recognise this formula. I took out the Greek letters and the subscripts to make it a bit easier on the eyes for non-technicians, but thereby destroyed any sense it might make to the actuaries. This is what we call the M-squared statistic, and it's a simple way of calculating a risk-adjusted return. So you're basically taking a benchmark return and adding on a proportion of the excess return, which is prorated by the relative volatility of the benchmark portfolio and the actual portfolio. So if the manager has taken greater risk, so higher volatility, then it'll reduce the return. Now, this is all very well, and here's a quick calculation of how it works in practice. There's 4 cases there of different levels of risk. The portfolio benchmark has a risk of 17 measured as standard deviation, and the return's 9.5. And you can see that if the portfolio risk is lower, then the risk-adjusted return is higher, and if it's higher, the risk-adjusted return is lower. That's all very well. That assumes, first of all, that you can calculate the volatility of the benchmark and the portfolio. And it also assumes that there is a suitable benchmark. There are plenty of asset classes where it's hard enough to find a benchmark, let alone measure the volatility over a period of time. So this would not be applicable to all possible cases. However, a modified version of this would be that, for example, you set a maximum range for risk measured in some terms. It mightn't necessarily be volatility. And if the manager departs from that range, goes outside that range, then a lower rate of performance fee or no performance fee is paid. I'll touch briefly on the proposed Cooper standard. In the paper, we go through in detail and look at the parameters that Cooper mentioned. Basically, Cooper has suggested that there should be a performance fee standard, and he suggested also that performance fees should be the exception. I think there's some concern that, given that point that I made earlier, that there are some asset classes which are quite valuable to producing good returns where performance fees are unavoidable. It would be a pity if this was implemented and trustees felt that they shouldn't pursue those asset classes because performance fees are not considered acceptable. And Cooper recommended that there be a standard developed by APRA in conjunction with the industry. Our feeling on this was that there's a fair bit of detail in the Cooper standard, the Cooper specification. We felt that if there is to be a fee standard, it should be a more general one, and it should apply to the process and the governance issues, and should cover all fees, not just performance fees, and should also apply to all types of portfolios, not just my super products. And in the paper, we've gone through and said, however, if Cooper's recommendation was implemented, then here is what we suggest the standard could look like. So the conclusions on performance fees are very simply, we think that they could be an alternative to asset-based fees, and the one advantage there is that they provide a way of getting around that commercial issue I talked about earlier on, in that a fixed dollar fee could result in fees that are higher than current bases. So a performance-based fee with a low base fee does enable us to get around that approach. Now, next part of the presentation is to do with the research we undertook into current fee levels. The research sources, the industry sources here, were a number of well-respected asset consultants, a number of funds, and some fund managers. And in the report, we've summarised the results of looking at fees for various asset classes and various portfolio sizes. Now, we are looking at this by portfolio size rather than fund size, and that has some significance which we'll come to later. We're presenting here just the Australian equity components. So looking at this first chart, we're looking at indexed Australian equities, and across the bottom, portfolio size. For very small portfolios, the vehicle is probably going to be a wholesale trust or an implemented consulting arrangement. For larger ones, it's going to be a standalone mandate, possibly a pooled mandate. The blue line there, the lower line, is the fee expressed, or the cost expressed as a percentage of assets under management, and the upper line is the dollar figure, the equivalent dollar figure. Out at very large portfolios, there are not a lot in Australia, but there are some, and they indicate the kinds of figures that are coming out. One of the interesting things about the curves we've fitted to those is that there seems to be a fixed dollar cost of managing very large portfolios, which is somewhere around about 300,000, 350,000, and there are significant scales effects there. If we look at active equities, the picture is different, as you'd expect, and of course there's no such thing as an active equity portfolio. There is a range of different types, as we all know. There's ranging through from low caps to quants, all sorts of different approaches. However, based on the research that we were able to retrieve, we constructed a similar sort of analysis, and we see that in terms of a basis point fee, for very large portfolios, we're coming down to about 20 basis points, and there is a much greater component that's related to size than there was with the indexed portfolios. One of the reasons why we looked at portfolio size rather than fund size is because if you're looking at fund size, you really are losing the effect of different portfolio mixes. And for funds of various sizes, if you're going to have around about 30% invested, for example, in Australian equities and spread it over a number of managers, you are not going to have a huge amount in each individual mandate. And so in this table, we're just showing that for a fund with $2 billion in assets, with 27.8% allocated to Australian equities, and the 27.8 comes out of the APRA stats, just it's the average across all funds other than self-managed funds. We're looking at a total portfolio of $0.6 billion for Australian equities, and spread over 5 managers, that's $120 million. Why that's significant is that when you look at a portfolio mix that might include indexed portfolios, you get a double whammy from the index component. First of all, you get the lower fees because it's indexed and not active, but you don't need more than one indexed manager. You don't need diversification, whereas you do with the active managers. And so looking at scenarios A, C, E and F, the missing ones are in the full paper. The first scenario, one index manager, very low cost. The case F, scenario F, 15 active managers and no indexed. There are funds out there with that many. C is where you split it 50-50 between indexed and active, and you've got 5 active managers. And so it is possible to achieve a reasonable spread of portfolio with some active management in there and keep the costs relatively low. Now, this is the area where those of you who feel that you can get significant performance out of active management would say, well, let's look at the trade-off for 20 basis points compared to the return. And that's quite valid. We would still argue that you're not going to have 100% of your Australian equities portfolio in low caps, for example. You will have a core that is lower risk. So just to summarise the conclusions from that part, we felt there is a fixed dollar cost of managing large index portfolios, and therefore there is some justification in a fixed dollar fee for index portfolios. For activist equities, there are scale benefits. They can be diluted by diversification, and the portfolio mix is important, not only to the cost but also to the return and risk. We also covered disclosure, and there are a number of issues to do with disclosure in the Australian superannuation industry, funds management industry in general. And we're not being critical of funds here. The lack of consistency in some areas is not due to attempts by funds to hide things, it's just that there isn't a standard. So the major issues here are there are some costs which are sometimes included in MERs and sometimes not. Generally, funds will say whether they're included or not, but it would be better if we could have a standard whereby we knew what was included and it was always done the same way. Hidden costs, there are costs bundled up in wholesale trusts, funds of funds and so on, which don't get disclosed and are difficult to disclose in some areas. And so that's not always clear. Performance fees have only been started to be disclosed in the last few years, and there is no consistent way in disclosing them as part of an MER that members could understand. Sometimes last year's fee is shown, sometimes a projected average of possible future fees is shown. And there's no industry information that is easily accessible to trustees. APRA collects information through its returns on investment costs, but they're direct investment costs. They don't include a range of other, they don't include, for example, the hidden costs. So what can we do about that? We've suggested including the MER statement inside the fund's annual financial statements, and thereby having them audited. And as part of that, the accounting profession develops an audit standard to ensure that we get consistency. And furthermore, to include that part of the audited financials in the annual statement, the annual trustee report to members. And the last one is that APRA could collect information from the funds about the mandates, the managers and the costs for each mandate, and publish those as part of its regular analysis, and also use that to help its own analysis and research be better targeted.
Thank you, Bill. There are 4 specific recommendations in the report that AIST has identified for further action, and I'll be taking you through each of these in turn. The message from the research makes it clear that this has been a useful line of inquiry for AIST. The research points us in a direction which is entirely in line with the purpose and current direction of AIST, and various findings and recommendations will help trustees and their funds in fee negotiations, hopefully in a way that will help with downward pressure on fees. And these include the recommendations about the implications of different fee models, the identification of a workable alternative to asset-based fees in the form of a transition to a fixed dollar fee plus a risk-adjusted performance fee model, and an increased emphasis on fee disclosure and consistency at a granular level. Now, Bill gave you the example, so I'll go over this very quickly, but it was particularly striking to us, and it really, the benefits of a fixed dollar fee compared to an asset-based fee are clear from the examples which are contained in the report. The comparison that Bill gave was for a $100 million Australian equities index mandate, which gives exactly the same dollar fee being earned in 1999, but the differing operation of the formula gives strikingly different results in the years after that. The 80% difference in fees that is generated on that example equates to a difference of $2.5 million over 10 years. And I emphasise that the example given is for an index mandate. It is likely that the difference would be even greater and more pronounced for an example using the different fee bases used by actively managed portfolios. What then are we going to do now? The Cooper report has of course been issued, and the initial flurry of media commentary has subsided. Many of you will have noticed in the presentation from the independents that the Henry review is going to be back onto the table, and that will have implications for superannuation. But now with a Gillard Labor government, the Cooper report also will be a document that has got ongoing relevance for both the industry and governments. And of course, I noticed that there was no reference in the independents' presentations to the mining tax, and so I think we can assume that the Gillard government will be proceeding with the increase in the SGC. These steps are going to be taken in consultation by AIST with its members. Today's presentation is part of that engagement process. These slides will be made available to conference delegates, and the whole of the research report will be posted online shortly for the downloading of AIST members, probably later this week. The research will also be published by AIST for distribution to its members and to other decision makers, and the research committee that oversighted this research and the AIST policy committee will be involved in setting a program of activities and monitoring the priority and focus of each activity. Turning now to the proposal for the adoption of a risk-adjusted performance fee model. The model requires that there will be a suitable benchmark, and for the user of the formula to be able to determine the volatility of both the return and the benchmark. This means that the model will be more useful for some asset classes than others. More information is available for listed equities, and so the model is more likely to be used for listed equities. And in order to confirm the extent to which the formula can be used for different asset classes and to assess its applicability in different market circumstances, it is intended that AIST will establish a reference group of actuaries and asset consultants. This will be established over the next couple of months, and progress will of course be reported to AIST members. AIST will also be making the details of the data used in the research available to its members, and will support members in implementing the model in fee negotiations if they so wish. Secondly, the report advocates a general statement of investment fee principles rather than a performance fee specific standard. This statement would provide a framework to assist trustees and asset consultants in fee negotiations. It is important to note that this doesn't go as far as being the fund management model that was part of the initial scope of the Cooper Review. So it's not intended that the standard would be prescriptive, but that it would operate in tandem with appropriate modelling of different fee scenarios. AIST understands that there are some industry participants who are already considering what an investment fee standard would look like, and AIST looks forward to working with them. Cooper called for APRA to be involved in consultation with industry over the performance fee standard, and we also call on APRA to be involved in the development of the Statement of Investment Fee Principles. Thirdly, AIST will be actively involved in the development of a fee disclosure accounting standard. The current lack of disclosure in the treatment of some investment components reduces the quality of disclosure to fund members. The way in which fees are structured, the different extent to which different funds drill down to report on fees, and the varying treatment of associated costs, such as asset consulting, are not clearly delineated by current statutory guidelines. There have been calls for greater consistency before, but it will be the development of an accounting standard that will provide the necessary focus and hopefully lead to a concrete outcome. AIST will establish an industry committee to engage with the accounting profession as soon as possible about the steps needed for the establishment of such a standard. This recommendation is likely to be of interest to APRA, and we'll be seeking to obtain their report and feedback for this. The last specific action point for AIST arising from the research will be to advocate for truly comparative data to be published by APRA. This will be the aggregate of the data supplied by funds to APRA for each of their fund managers. The standardised MER data that Bill talked about will be the cornerstone that ensures the value of the published data. Super funds, we anticipate, will be the major consumers of this data, and it will assist trustees to assess the fees they pay against the average fees paid by funds for similar fund managers. Of course, there can be reasons why funds pay more, but at least having that comparative data will enable them to make the assessment about whether value is being delivered for those additional fees. And AIST will make specific submissions to both government and its regulators on this proposal, and will seek broad industry support for it. So all in all, AIST will be putting together a broad program of activities and tasks in the investment management fee space, and this will be an important part of the AIST policy deliberations, and progress will be reported to AIST members. Thank you for your attention.